The markets are open. This is Squawk Real Time.
Right, we are called to have a pretty flat, slightly higher start to trading on these equities by the futures and the spread bettors as well. But there's so many elements going in at the moment. I actually think it's really exciting, and I'm seeing some amazing differences and the lack of correlation. For instance, look at those figures we had from Pernod Ricard a couple of weeks ago, which were warning on the fact that spirit sales in Asian markets were not looking so good. And then we get some really decent figures out from LVMH that cognac's doing rather well, as indeed are branded leather goods as well. So I think that gives you some really interesting pairs trades, some interesting individual opportunities, and we're getting it across the board as well. So we're called to open slightly higher. We have opened in the most well, we're flat, aren't we? 323.15. Let's go and have a look at some of the sectors as well. The backdrop, of course, again, is enormous oscillation. Facebook, great stuff out of them. Google, pretty positive as well. Amazon, not so positive last night as well. And that's been the theme. There is, i.e., no necessarily a coherent corporate picture. The economic data remains quite good, doesn't it? Let's face it, the US data yesterday with an 11% increase in exports, 3.2% annualized GDP figure was pretty positive, so it justified what the Fed had done. And yet you've got the Indian central bank governor in an interview bemoaning the lack of coordinated action. He is right, but let's face it, when was the last time you saw coordinated action on the global economy? I think it was April 2009. I think it was the G20 when we saw $1.1 trillion put into the global system to shore it up. So coordination, yeah, it would be nice to see, but we haven't had it for a long, long time. Autos, biggest declining sector so far. Daimler, Renault are two of the big fallers. I say big fallers, they're down about 0.5%. Insurers also looking easier today. ING, Royal & Sun Alliance are the biggest decliners there. Saint-Gobain and Lafarge out of France from Bouygues as well are the biggest fallers in the construction sector. Have we got anything up? We have, actually. We've got some telcos looking better. I know why telcos are better, so do you. It's BT, isn't it? Let's have a look. Where are they? Yeah, they're up 2.8%. They've had a good run, though. You've got to make a bit of a decision here as well. I mean, we heard from Nick Stanievich that he thinks Gavin Patton's doing a really good job taking over from Ian Livingstone and concentrating on getting the debt down, growing the product offering, the revenue figures turn around as well. But the shares, look at the year basis, look at the 2 year basis, they've had a really good run. So you've got to look at the valuations, and they don't look too bad versus the broader sector. 381 is where they're currently trading at the moment. We had, obviously, B-Sky-B yesterday, Andrew Griffiths on this show saying, yeah, they can still grow the offering. BT obviously still think they can grow their TV offering as well. So is there room for both of them in this market? Possibly, yes. Household goods. I love this sector. Only in Jeff Cutmore's household is household goods, LVMH and Dior and Burberry and Hermes. The rest of us, it's kind of more things like Jif and stuff, isn't it? Anyway, he's not even listening. He's had the same barb for about 5 years now. But, I mean, it's true, isn't it? Mrs. Cutmore, I mean, she's got this stuff in every cupboard, you know, putting the dusters and stuff in there. Anyway, that's LVMH doing very well today, up 6.2. He doesn't want to get involved. Save it. Save your ammo. Let's have a look at the BT then on the FTSE 100. FTSE's flat. BT is up. BT revenue growth for the first time since 2009. Revenue for the first 3 months, well, for the 3 months in of December, up 2% to £4.6 billion, just a decimal above the 4.5 billion expected. 380 is where they're currently trading, 9 pence to the good. They're CAC 40, again, household goods. Cutmore household. LVMH, we know they're up over 6%. Let's have a look now. They move much? Yes, 6.3%, 130 euros, 8% rise in like-for-likes, 2013. Again, the cognac story. I mean, look at what has been said by some of the rivals, Pernod Ricard, compared with LVMH. Not a coherent story in that sector as well. Anyway, they're doing rather well, 6.3% higher at the moment. Areva. This is confusing. You've got Aviva, Aveva, Arriva, Areva. This is... I don't know if I'm coming or going. I think there should be a joke somewhere there. But Areva is the nuclear power group that has such enormous cost overruns on the Finland plant. On the one, is it Flamini in France as well? So you kind of think this is an industry which has got a whole host of issues. Yes, nuclear power plants are still being built globally, but the Japanese, I spoke to Mr. Yamamoto last week in Davos, the Science and Technology Minister, said no, nuclear at the moment isn't part of the broader picture. They're still yet to give their long-term energy assessment. So nuclear in Germany, in Japan, it's a bit of a dirty word at the moment, but whether there is a long-term future for these new range of, I think it's EPA plants, isn't it, which are very expensive but very, very safe, remains to be seen. But Areva shares down 2.2%. Anyway, let's get back to the man. Are you buying any luxury goods this weekend?
I'm not buying any luxury goods this weekend. How much longer do you think we can keep name-dropping from Davos? Probably gets
around 51 weeks until we get there next year. I think or at least until we get to Spieth, anyway.
James Butterfield is with us, global equity strategist.
He's not one of the chief equity strategists at Coutts, is he?
He certainly is. Yeah, and Yianos, is, of course, is still with us from Eurobank Asset Management. So goes January, so goes the year, so goes the saying. Is it going to turn out to be true in this case?
It's all about the taper, I think, is the bottom line, and mixed in with a little bit of politics. When the market seems to be behaving in a way the opposite to the way it used to, so it's selling on the rumour and buying back on the news. And since the taper, the FOMC decision came out a few days ago, it seems the markets are starting to pick up again, even emerging markets. But it's told an interesting story, particularly in emerging markets, and you can certainly start to pick out winners and losers. And a lot of people have talked about current account deficits in emerging markets, and that's what's really hit them. But I think it's also in combination of those with large external debt burdens, so those with dollar exposure. If you combine those, I think the story really makes sense, and you see countries such as Brazil, Turkey and Indonesia and South Africa really getting hurt, whereas perhaps China, the Philippines and South Korea perhaps a little bit more resilient.
So what are you recommending your clients do today?
So we in the emerging market space, we do like China, Philippines and South Korea. I appreciate in the shorter term China has some challenges, particularly around liquidity and transparency. The most recent debacle over the default and these mining licenses, that's quite an interesting space and a real litmus test to check whether the plenary reforms, they're really committed to the plenary reforms.
James, if you're differentiating in an emerging markets route, as we've been experiencing in the last few days, does this mean that basically you're bullish? Because if you're differentiating, it means that you can actually do this profitably, and as such, it's something that the market will see through. Why not just buy the whole of emerging markets?
It's because the issue we have today, particularly like Turkey is a good example, with a large current account deficit. It's got a problem with its currency. Clearly, trying to strengthen the currency only lasted a day there, and it's going to force that particular country to start engage. It's had these sort of the hefty dose of QE, and it hasn't had to think about its structural reforms and its fiscal reforms. And now that tapering is occurring, it really will have to think about that. Combined with that, it has elections coming up, and there's quite a few other countries, such as Brazil, South Africa, and a few other countries that do have elections coming up, and that's a heady mix of uncertainty there. It might tar the whole of emerging markets with the same brush, but then the markets will work through that, and that's where we see the opportunity is.
One might argue actually that having a lot of elections might actually be a release valve at this stage for including, emerging markets. In essence, we have political problems in Turkey. Great, you're going to have elections. You're going to have a result. Is that going to change institutionally the place? Probably not. So you're either going to have a continuation, so things should calm down on the political side, or you're going to have a change, and that's going to absorb part of the pressure.
Well, I think the changes come after the elections. Clearly, any kind of politician coming into an election is not going to engage in a severe austerity programme. It's not till after the elections that we start to see these changes. And that's why, particularly in the first half of this year, for some emerging market countries, it leaves them quite vulnerable.
This is a screaming buying opportunity for developed markets, isn't it? Especially for European markets, even though these Euro Stoxx 600 trading at 14 times earnings, maybe a little bit above average, but you could still think at 6-week lows, fantastic buying opportunity, isn't it? Same applies to the US markets, doesn't it?
Yeah, absolutely. It's about relative valuations. We are a bit more cautious on the US just because the relative valuations aren't that attractive. But in Europe, we still think they are. The problem with earnings, in particular in Europe, is we're coming out of a recession and they're still depressed. If you look at price-to-book measures, Europe still looks quite attractively valued on that metric. But again, it's about being selective. There are countries such as Germany, for instance, which have proven throughout the stronger euro that it's still managed to export, and on a relative basis, it looks very attractively valued.
Do you reckon? That's a bold call, Carolyn, isn't it? Again, we had Bob Schiller with us in Davos, and of course, and Bob Schiller on this cyclically adjusted price-earnings multiple says the US is way expensive. It can go higher, of course, but it looks pricey at these levels.
valuations, they're a historical measure, aren't they? Just because something looks pricey by historical measure doesn't mean that they can't go higher. And if corporate profitability is rising, so should the share markets, right?
It's crucial. I don't think the US is overpriced. It's just relative to some other markets when it comes to the game of portfolio management. That's how you have to look at it. I mean, I do have issues with Schiller PE. If you strip out just 2 months' worth of earnings data in 2009, the Schiller PE falls from where it is 25 times now to around 17, 18 times. So it makes a massive difference, just those two very big months. And that's a problem with cyclically adjusted PE sometimes. It can perhaps over-penalise markets.
Yeah, strangely, Robert said he had a few problems with Coots as well. No, he didn't say that at all. But what do you think, Yianos, just before we get back to Steve?
I just think part of the argument on the US, well, there are two things that one needs to answer, and all of us need to answer. If we're concerned about emerging markets, seriously concerned, and if we're concerned about the US, in essence, can we have another 5-10% drop in the S&P and the European stock markets doing well? Can we have another 10-15% in drop in emerging markets and developed markets doing well? So is it truly a relative call? That's the first question. And the second one, with respect to the US, is that there are two things that have supported the upturn now in the U.S. cycle, especially in the last, in the latter part of last year. One of them has been the real estate market, and the other one has essentially come from the markets themselves, supporting the consumer, right? The upturn that we've had, tremendous, has supported the buying power of the U.S. consumer, and so on and so forth. Both of these aspects are endogenous to interest rates in the U.S. and tapering. So what you really are making an argument for is essentially circular, right? If tapering becomes much more of a, let's say, an advanced stage proposition, then both the real estate market, which appears to be cresting, I think, forget about the Case-Shiller estimate. Yeah. All the other data that we get from the housing market in the US basically tells you that the process is slowing down.
All right, let's throw that question at you.
Well, I think it's the Fed has been quite cautious about this, and you can't take it as a given that tapering is going to occur every month. You have to see the macro data back it up, and the Fed's been quite open about this. And if the macro data doesn't stack up, at the moment it seems to. I mean, a lot of the issues around payrolls have been, particularly payrolls, have been the issues with snow, for instance. And if they don't persist, then it's likely the Fed will continue tapering. I admit there is some uncertainty. We think Yelen's a dove. She is untested by the markets, and it will likely create some form of uncertainty. But it does suggest that they'll continue tapering. But if you look at just before tapering occurs, you see VIX spikes, and then after it, we've had these tests. We've had May, we had discussions about tapering in June, and then September, and then December. Each time the VIX spikes very aggressively, and then calms down right afterwards. So again, as I said, it's about markets selling on the rumour and buying on the news.
Steve, back to you.
Right, okay, let's move on. Take a look at the IBEX, which is trading flat at 99.66. But is the fact that we have a higher level of non-performing loans being declared by the banks a sign that actually they feel they can handle a bit more bad news at the moment? Maybe Banco Popular swinging to a net profit in the fourth quarter 2013 from a steep loss the previous year. BBVA profit for 2013 up 33%. CaixaBank 2013 profit doubling, albeit to only 503 million euros. Let us ask Stefan Pedrazzi the question. Stefan, hello?
I was looking at the board. Banco Popular is down 1.6%. You can update your graphic. So, Steve, we had 3 earnings this morning. BBVA was unprofitable in the fourth quarter, but that was expected. It's due to an exceptional item. The bank sold a 5% stake in a Chinese bank, CITIC. However, in the fourth quarter, the loss that BBVA reported was smaller than expected. On the full year, the bank beat expectations with a net profit of 2.2 billion euros, and the net interest income, which is really a key metric because it's the difference between how much the bank charges for loans and how much it pays for deposit, was also higher than expected on the fourth quarter, up 6%, which means that the core lending business is picking up in Spain, at least for BBVA. Bad loan ratio a bit higher at the end of the year, but that was expected, 6.7% for BBVA, and that was 6.8%, and that was still well below the average of the Spanish banking sector. In terms of outlook, the chairman of the bank says that the outlook for this year has improved significantly as the demand for credit is rising, and that explains the positive reaction on the stock. Now, as you can see, Banco Popular is trading lower. So is CaixaBank, the third largest Spanish bank, more than doubled its net profit last year, but missed expectations because of a weaker than expected fourth quarter, and that's the reason why we have a negative reaction. Banco Popular, as you said, Steve, returned to profit after a massive loss last year, 2.4 billion euros, but behind the top line there are two disappointing indicators. First of all, the net interest income was slightly weaker than expected, and secondly, the bad loan ratio surged in the fourth quarter to 14.2%, up from 11.8 at the end of the third quarter, and that explains why the stock is trading much lower. That's it from Madrid. Back to the name-dropping session, Davos in London.
I don't think we've name-dropped that much. We've just named about 30 of our guests from Davos in this show. I think we interviewed about 80 people, Stefan. Anyway, enough about that. Did I tell you about my chat with Larry Summers? No, I didn't. OK, let's move on anyway. Zetratax. We did. We also spoke to the boss of BBVA, funnily enough, as well, Mr. Gonzalez. Absolutely, that was a great interview. If it's still on .com, you should have a look at it. He had some amazing comments to make about the future of the banking sector, about where it goes next. I think the video is still there. Really interesting, because the threat, technologically, he says not from the other banks. He thinks it's from the Googles of this world, the Facebooks of this world. He says BBVA are ready. Anyway, enough about our chat with Mr. Gonzalez. Let's have a look. Zetratax is 0.4% lower, 93.39. I want to talk in a few moments' time about Salvatore Ferragamo and what the numbers tell us. We'll do that in a few moments' time. Jeffrey?
It's funny that you mentioned that, because luxury very much on the words of guests around the desk. James was just talking about LVMH.
Yeah, well, I think it's interesting. It's symptomatic of the sector, in our opinion. If you look at, say, global blue data, China, for instance, spent 102 billion in 2012 internationally on luxury goods, whereas the US only spent 83. So clearly China is a big consumer, but it's not just about China. There is quite strong sales growth in other markets, but overall for the luxury sector in Europe, sales growth over the last 4 years have risen 11%, and that's on the face of luxury goods on average rising 7% themselves. So despite this, yes, that's over triple the amount of inflation, and despite that people are still buying these goods, so that's very positive.
Let me just come in here. Let's do this Ferragamo thing now, then we'll carry on the conversation, because I think LVMH looked amazing. I mean, the figures were fantastic on the cognac and on the leather goods thing. Let's do the Ferragamo story as well, just to put this in a bit of context as well, because we've had Mulberry already this week, which is pretty much warned on product. You've got LVMH who are doing rather well. Let's find Salvatore Ferragamo. Now, it is up 6%, but let's just take a look at some of what they've said about the numbers. Asian growth has moderated. Ferragamo said global revenue rose 9% to 1.26 billion euros. 9% increase, that's great, but it's about the rate of change, isn't it? Because they were growing last year at 17%. Still growing at 9%, were growing last year at 17%. In Asia, where the group makes more than a third of its sales, the rate of revenue growth has dropped to 10% from 18% in 2012. This is fascinating as well. So look, but the shares are looking fantastically. Let's find out what's going on here with Claudia, because she can tell us so much more about the luxury goods arena as well. I would have looked at these Ferragamo figures and thought, hang on a second, their growth rate is dropping off a cliff, but the market likes it. Why, Claudia?
Yeah, it is a bit surprising to see that stock trading higher. It was actually suspended limit up right at the start of trade, especially on the heels of Todd's, where they came yesterday in with their numbers missing on expectations of the analysts. And so the stock was really hit hard. It lost significantly yesterday. Now, independently of how it's performing on the market today, as it may be a better pick than others, really longer term, the idea that this slowdown in Asia is coming around, or could be coming around even stronger, is, of course, of concern. But again, China posted a 20% growth rate for sales for Ferragamo. That market in Asia still represents a large part of their business. In fact, it's about 1/3. In just China is 1/3. So Asia is the largest market. To note also on a positive news there is also how Europe performed. Europe was better than expected. North America also. Europe rose by 13%. But remember also that what affects that is the traveling sales that are made from Asian customers that come to Europe and buy actually in Europe and Italy and Paris and enjoy shopping in those stores and actually want to make their purchases here in Europe. Now, as far as those store sales, which is a significant number where the numbers should be stronger in their owned stores, the numbers there are a little bit weaker for Ferragamo. As far as how the stock has performed, just to get an idea of what's going on there, their shares rose about 60% in 2013, and since the start of the year have fallen about a fifth of that so far. As far as also how brokers are reacting, well, yesterday the group Societe Generale has put a sell rating on Ferragamo, putting their target price at 21.5, and at the time it was trading at around 22.4. So this upside performance here on this Friday is a little bit of a surprise, but again, could be because it's a better pick than others, with LVMH numbers also coming out. Back to you.
Thank you very much for that, Claudia. Let me just say on the share price, very interesting. I did a little bit of a look on this one, guys, and just to show you where the shares have come from. They were at their peak of last year on the 2nd of December. They're around about €29.54. They're now trading 22-ish, Salvatore Ferragamo. They came up from 2011. €10.45. So they tripled from 2011 to their peak in 2013, which I thought was absolutely fascinating given what was going on in the world economy at the time as well. In terms of valuation as well, I've got Salvatore Ferragamo trading pretty rich actually. Forward PE of 22.69. The sector trades on 16.6. To put that in reference, Burberry trades on 16 times, LVMH trades on 15.6. So if you want a luxury goods play, it's not the cheapest out there, is it?
I agree. That does sound expensive. I mean, if you look at the sector overall, it does trade at a discount. It always trades at a premium to the market. But luxury goods sector at the moment continues to trade at a discount, despite some of this pretty good news out.
But we're never going to go back to the heydays of China from, what was it, 2009, 2010, where the likes of Swatch and Richemont saw double-digit growth, just because the system has changed. There's a crackdown on gift giving.
On the gift giving, it's been select things that have really got hit. So sort of luxury alcohol, so Remy Cointreau is a good example, and watches have taken a real hit, whereas apparel and jewellery haven't taken much of a hit, in fact. So again, it's about being a little bit more selective.
With regards to Remy Cointreau, we saw disappointing numbers, but this morning LVMH saying we're actually going to see a pickup in cognac sales in China this year. Is this just a dead cat bounce?
I don't know whether there's a little bit more relaxation on gifts of Remy Cointreau. I'm not quite sure, but I mean, I think Diageo is a good example. They spoke too about slightly lower sales growth in emerging markets of around 1%. But you know, it's not just about emerging markets in China bolstering the luxury goods story. It's also the United States. With a stronger dollar, they will be buying up more. I mean, in the United States, we saw an 8% growth in 2012 of luxury goods. So it's quite possible that as the dollar strengthens, that the US takes up that slack from China and Asia.
But Abenomics is also at play here, isn't it? With the weaker yen and especially with rising household income in Japan, they've been very strong buyers of luxury products. So much of their fortune also depends on the success of Abenomics.
That's quite possible. I mean, the weaker yen might have an impact. I mean, I haven't done sort of the aggregate figures to try and work out exactly how it's going to impact the luxury goods sector, but if you look at the forecasts, they're being upgraded all the time, not sort of downgraded for the luxury goods sectors. All
right, we'll send it back to Steve.
Yeah, I just want to round off this equity market run. Take a look at the OMX, up 0.18 of 1%. I want to look at Electrolux. I'm going to do this for one reason and one reason only, and that is the fact that the shares are down 4.5%, and that's on the back of the numbers missing. It's very simple, 1.22 billion krona. Operating earnings, the mean forecast was 1.33. They're down from 1.59 a year earlier. But one thing they have done, which is the first time I've seen this from Electrolux in a long time, they have actually raised their 2014 European demand outlook. And I thought that might have had some street cred with the market, but clearly the miss on the numbers is what they're concentrating on. Anyway, we'll be able to ask these two opposing factors with the CEO of Electrolux. Keith McLaughlin will join the Worldwide Exchange team. That's Karen today, 11:10 Central European time. That is a first on CNBC interview.
So the theory goes that as we transition out of this period of ultra easy money, economies recover, sustainable growth, top line earnings rebound, that justifies the earnings multiple that we've seen expand here. So, James, what do we know so far from the earnings season in both the US and Europe that stands up that thesis?
It's been pretty good in the United States. I think we've seen 111 beats versus only 56 misses. So pretty strong ratio.
Sorry, got to jump in. 10 out of 11 pre-warnings were, or pre-statements by companies in the United States were warnings, were downgrades of estimates. You're not telling our viewers to get puffed in by the beats, are you? You know this better than anyone.
Yes.
You know this better than anyone. They call it down to beat.
That's absolutely true. So analysts have been downgrading aggressively, and it set the bar pretty low, admittedly. But also, if you just look at year-on-year growth, we see sales growth is up 2% year-on-year. In fact, sales now have picked. In 2013, we saw a decline in sales growth following the 2012 year-end results. But now we start to see a pickup, and it's gone above that peak now in sales. So that's very encouraging. And profits now rose, I think net income will rise 14% year on year in the United States. So pretty encouraging story in the US. And even in the tech sector, where it was in the doldrums particularly, that has really supported earnings this season. With, I think, out of 35 that have reported, only 2 or 3 have missed estimates. And it's strong growth. It is a story about particular companies really outperforming, particularly those companies exposed to data, mobile and automation. But
James, why aren't you not enthusiastic about the US market then?
Again, it's about relative valuations. We see better opportunities in Europe, where the US is it's well priced, the story of the economic recovery, whereas in Europe it's just not as well priced. But admit it, it's not that we don't see price appreciation in the United States. Our estimates are between 7 to 9% year-on-year returns on the S&P 500. It's just that we expect Europe to outperform. So it's not that we don't like the US.
And currency adjusted, is that the differentiation still stands? Because you mentioned something about the stronger dollar.
Yeah, we try to strip out the sort of currency effects of this, and at times if we were concerned about currency, we will hedge. We're not doing that in the US at the moment, but that's how we would deal with that.
James, thanks so much for coming in. James Butterfield, Global Equity Strategist at Coutts. Yianos, you're going to stay with us. We've already taken one look at African opportunities. Now we're going to take a second look. Stay with us. We'll be back. We'll look at how private equity is taking advantage of a growing middle class across the continent. We'll see you in a moment.
Highlights from the CNBC Brainstorm on Emerging Europe in association with Erste Group. Decision makers from around Central and Eastern Europe gathered in Vienna for a CNBC Brainstorm.
This region must be the leading in the process of transfer of information. Information is key.
Piloting self-regulation programs, this is big in the US these days.
The problem with the region is it doesn't have attractive consumers, right? Spending power is not particularly high, and it's going to go down. As people get older, more money go into the retirement system and not into the market.
CNBC asked participants to explain this headline from the future: what radical restructuring occurred to ensure a prosperous and sustainable economic future for the CEE region and its people.
As part of the joint CEE union, there's a joint task force to control corruption and enforce, go after corrupt government officials.
We'll pay for it, sir. We'll pay for it.
No. It doesn't matter.
Okay, it doesn't matter. It matters.
As a first step, we taught all ministers to speak in English.
It's a single stock market for the entire region, just to deepen capital markets, so companies have access to non-debt funding.
State-of-the-art education system is the key to wealth in the future. We are now in the middle of the lost generation, and we need to develop and invest in the young generation.
Things we've learned from Western Europe, avoiding them and picking the good things.
Tables then had 90 seconds to pitch their ideas to the room.
Make Eastern and Central Europe the powerhouse of global growth is cool cities of the 21st century.
We would raise entrepreneurial kids who are creative, risk-taking and independent.
There should be a huge investment in infrastructure, electricity grids and roads and education.
We reduced and eliminated.
The winning idea came from the perspective of the consumer and proposed ending the so-called brain drain. Getting young people to stay in the region was the best route to long-term sustainable economic growth. Highlights from the CNBC brainstorm on emerging Europe in association with Erste Group.
CEE produces every second car in Europe. CEE is the leader in renewable energy resources. CEE is outgrowing the rest of Europe, and that's just right now. Now imagine what CEE will be in 2025. Central and Eastern Europe. When it comes to CEE, come to us. Erste, real banking since 1819.
The Nikkei closes January down 8.5% as Asian markets shut up shop for the Chinese New Year. Europe opens on the flat line, failing to match gains in the US overnight. High-end fashion and cognac driving up sales at LVMH as the luxury giant beats expectations. From luxury goods to white goods, but different fortunes for Sweden's Electrolux, which falls to the bottom of the stock 600 on weaker profits. And a record number of subscribers for its broadband and TV services helps BT top forecasts. The company continues to take the fight to rival B-Sky B. Shares trading towards the top of the London market this morning.
Right, let me just give you some flashes that are hitting the wires regarding Sellafield, which is a nuclear facility in West Cumbria in the northwest of the United Kingdom. UK nuclear site Sellafield says elevated levels of radioactivity at one on-site radiation monitor at the north end of the site. Now, the site is operating normally, but with reduced staffing levels due to detection of elevated levels of radioactivity, said Reuters. Now, I've just done a little bit of a search, and a local newspaper, the News and Star, is saying the company says it's in response to an operational condition, and the decision to suspend day operations was taken with the safety and security of the workforce as a priority. It is not clear what has prompted the closure, although the company says a monitor has detected, as we say, these elevated levels of radiation. The company statement says this is in response to an operational condition on the site. They are monitoring the broader radioactivity levels with reduced manning levels as well. The site will continue to operate on shift manning levels. All day personnel, including contractors and 5- and 7-day double day workers, are asked to remain at home unless asked to attend. All 5 cycle 12-hour continuous shift laundry, canteen, utilities and transport personnel will attend as normal. So there you go. If we get any more flashes on that one, we will bring them to you imminently. Let's get to the markets now with Carolyn.
Let's show you what the Stoxx Europe 600 is doing. It is down. Yes, down once again. We've been down for the last 7 trading sessions because of this emerging market round. And even though we did see that rally in Wall Street, and we didn't get much direction from Asia, to be sure, because Shanghai is out for the New Year holidays, but the Stoxx Europe 600 continues to decline today, off by around 1/3 of 1%. Want to show you what the sectors are doing one by one, because we've got that rally in household goods on the back of the LVMH numbers, up by 1.4%. Retail also doing well, supported by Kering shares, up by 0.4% for this specific sector. And telecoms not doing too badly on a down day. Of course, it's all about BT this morning. Insurance, banks, and autos are among the biggest decliners on the Stoxx Europe 600 today. Let's move on to the biggest movers and shakers on the Stoxx Europe 600 in terms of individual stocks. Now, we've got Banco Popular in Spain, off by 2.6%. Actually, numbers were a little bit better in terms of the bottom line, but bad loans at the end of the fourth quarter rose to around 14%. That's up significantly from the last quarter, and we've talked about whether this is kitchen sinking by some of the banks because they're more comfortable about disclosing their bad loans. I don't know, but it's sure to say that investors not taking this as a very good sign. Electrolux, we're going to be talking to the CEO on Worldwide Exchange. Shares down by 4.4%. The company did flag an uptick in the European markets in 2014, but earnings were worse than expected. And of course, LVMH, the standout performer today, up by 5.75% on the back of better than expected numbers. And it sees rising cognac sales in China.
Thanks very much, Caroline. Africa's GDP of $1.5 trillion is similar to that of Brazil, India or Russia, and is expected to grow faster than most non-BRIC emerging markets. Not surprising then that many companies have significantly stepped up their presence across the continent. Where do the growth opportunities lie? Michelle Catherine Esome joins us, CEO of African Venture Capital Association. Michelle, welcome. Good to see you this morning. Well, let me just throw that question out. Where is the opportunity in the African marketplace for an external investor?
I think there are a plethora of them. I think it's the entire continent. And I think it's interesting. You have a continent of 1 billion GDP, 54 countries, thousands of languages. And the opportunities are really sectorial. Consumer, financial services, telecom, banking the unbanked, as well infrastructure, ports, transport, logistics. So whatever it is your business, to your point in your opening statement about multinationals looking to Africa, there's a tremendous amount of opportunity because it's been a continent that's been overlooked for so long. So
what's going on here? Because I looked at there was a piece in the International Business Times that talked about the value of private equity and venture capital investment in South African companies falling drastically in 2013, and there is some evidence that there is a pullback, not just in South Africa, but there is maybe a reduction in the amount of money that's being invested in projects at the moment. Are there just not enough obvious low-hanging fruit targets for this money, or is there another reason for people exiting at this stage?
No, actually not. I mean, South Africa is a beautiful outlier. It's developed, and I think its life cycle, if you will, to generalize, is a lot further than, let's say, Nigeria or Ghana. So I think it's, you have slower growth, but I think that the opportunity is for South African companies to expand to the rest of the continent. And if you think about private equity, and we're going to be discussing this at our conference in Lagos, bringing lots of investors. If you think about private equity, their goal is to find a good domestic or regional company to make it continental. EcoBank is a good example. Letshego is another example. And, Rift Valley Railways from North Africa to expand it. So I think it's an opportunity if there's slower growth domestically, like South Africa, for example, to look at opportunities in the rest of the continent. I don't think that investors are exiting. I think that they're trying to find smarter ways to exploit opportunities in the rest of the continent. You have so many people who don't have bank accounts, thus the growth of mobile money, and kind of leapfrogging what we've done in the developed world. So, the opportunities are huge. The huge obstacles, it's not at all easy to do business in any emerging market, no less Africa, where you have countries that are English law, Francophone law, Lusophone law. It's very different one country to another.
Michelle, what has gone wrong in the past when there have been previous attempts to, transition into a different stage for many African countries? And what do you think is the biggest challenge nowadays? Is it already too expensive?
I think actually now is the best time in the history of the continent. And you have a plethora of factors. You have a returning diaspora that are very educated, that are wealthy from other countries, bringing wealth back. You have an emerging middle class that have money to spend on disposable goods, so it's very good if you're Procter & Gamble. You have a continent that's really not debted. Right? There's no crisis, there's no euro crisis. You don't have this malaise that, it's experiencing in the rest of the world. So they're really free to grow, and that's really what is happening. So private equity has been there for the last 20 years. Before that you had CDC, the DFIs investing directly. And now there are all of these exits, so we're returning money to investors. So, I'm paid to be optimistic, I'll admit it, but I really don't think that they are, investors need to be worried. I think if you're an emerging market investor who's invested in Asia or Latin America, you apply the same screening mechanisms. You build a good team who's got access to deal flow on the ground, or you partner with someone and you look for those opportunities.
But Michelle, how do you know that the money that's flowing into Africa right now isn't just the hot money that's flown into other emerging markets? How do you know it's the sticky FDI?
I think any investment is good.
It's not. No, it's not. Because what we're seeing in the emerging markets right now, this was spurred by the Fed's easy monetary policy. So if this happens to Africa too, in 5-6 years' time, you're going to have a rude awakening.
Private equity is sticky by nature of the asset class. As you can invest in a private equity fund and get out in 3 years. So it's, we're not talking about equity markets or bonds, we're talking about private equity, so virtually sticky.
And there's a lot of African money that wants to find a home as well. But I have an issue. Why is it that Shell and Chevron are having such issues in one of the best prospect countries? Let's say Nigeria's got 173 million population, can overtake the US in population in terms of 2050. So it's a perfect country for what you're saying as a metaphor for the continent as well. Why is it that it takes someone like Aliko Dangote to turn around and say, oh, actually, I'll pick up those assets, I'll have that petrochemical plants, I'll do this, when the international companies are failing to turn around the kind of growth potential they thought they were going to get out of Nigeria?
I mean, I think that there are many complexities. There probably isn't an easy answer, and I don't know specifically to that example. I think Dangote is a perfect example of kind of a bootstrap, really smart, someone who's pulled himself up by his bootstraps, and there are many others. Mo Ibrahim is one, but there are many other examples like that of someone in a difficult environment bringing new. So, you know, I don't think that by virtue of emerging markets that it means that it's easy.
But let me just carry on with the Nigerian metaphor, if I may, for the continent as well. And I've had a lot of pleasure speaking to the finance minister, the central bank governor, many times the oil minister as well. And yet they've got an interesting period ahead. They haven't even got an election in 2014, but they have kind of, because it's 2015 presidential. And yet they're not balancing the numbers on the deficit because of the lack of oil supplies coming through. They're not making their 2.5 million barrels a day. And that leads to instability on the financial front, which makes it more tricky, surely, for investors. If they've got a long presidential run-in, they've got a big deficit as well, they're not getting the oil revenues through as well, that makes it hard to invest in the country, despite all those wonderful demographics.
You know, someone said to me, an investor said, you know what, I feel really uncomfortable about this country, but there are lots of small and medium-sized businesses that are attractive, and that's really where private equity plays. Yeah. You know, it may not necessarily be, you know, working with a governmental entity, it's investing in really good entrepreneurs, and I think that's where we all should be looking.
Sure.
Trouble is, it's just to pick up Steve's point, it's a bit of an insider's trade, isn't it? I mean, the numbers speak for themselves, and there has been a massive increase in private equity and VC interest in all of these countries, you know. But it seems to me that unless you kind of understand the psyche of the local marketplace, you probably are going to put money in and lose it.
Yeah, which is why I said you have to hire local teams. Yeah. You can't be sitting, you know, outside of the continent. You need to hire local teams who've been educated, you're aligned, and look for investment opportunities that way.
To what extent, and I bring China back into this, to what extent have the Chinese activities in Africa removed some of the real opportunities for the VC world?
I think that's a good question. I'm glad you brought that up, because it really confuses the investor. You know, the Chinese or the Indians typically deal with the government and they're doing infrastructure projects. Private equity investor, you know, whether it's Carlyle or other large buyout firms, are really looking for privately held companies. So they're not necessarily investing with you know, with alongside the Chinese. I mean, to the extent that you have investors bringing in FDI to improve infrastructure, roads and ports, that all helps development of these economies. But it's not necessarily a factor in the private equity industry.
Great having you in. Thanks very much for coming to us. Michelle Catherine Asome, CEO of African Venture Capital Association. Squawkbox Europe at cnbc.com is our email address if you want to get in touch this morning. We'd be very happy to hear from you.
And of course, you can follow us on Twitter at Squawkbox Europe. Jeff.
Some breaking transfer news. Roman Abramovich has offered a bigger bucket of carrots to the donkey. It's now heading to Chelsea. West Ham are getting desperate, but they've got their top scout out on the job.
Stop. You know, there's a little club called West Ham who'd be very, very happy with your services, even now, if you decide to come out of retirement.
If it's not probable, 20 kilos more.
If you look at Europe for the next 10 to 15 years, there is only one place where you want to be, and that is Central and Eastern Europe. The CE region had a chance to watch many of the mistakes that Western Europe made. So it's still the region where you have extremely low taxation, an extremely qualified labor force. Most of the countries of CE are in financially substantially better shape than Western Europe. Much lower indebtedness. And they're geared for growth. The biggest challenge for Central and Eastern Europe is very simply to keep talented young people in the region. and to attract talented young people from outside of the region. Central and Eastern Europe can definitely be the fastest growing region in Europe and maybe even one of the fastest growing regions in the world. Central and Eastern Europe has all the ingredients. They just have to grab it. It's there. It's on the plate.
Erste Group. Real banking since 1819.
Imagine the possibilities and weigh them by the probabilities. Good advice for navigating through life, directly applicable to investing and the very essence of options trading. At interactivebrokers.com/probabilities, I tell you a practical way of thinking about options without complicated mathematics. The most valuable half an hour you could spend on this topic.
Discover a pioneering Forex investment platform from the best FX broker of 2013. FX Pro. Trade Forex like a pro.
Did you know that Russia is the world's 6th largest economy by GDP? Invest in Russia with Russian Direct Investment Fund.
These are the top stories trending on cnbc.com. A new year might not be the only cause for celebration in China. Some analysts say it won't face a hard landing this year, despite a string of bad economic data. Find out why on cnbc.com. Emerging markets may be coming under the cosh, but the future for the Philippines is looking bright. That's according to one economist who lists 5 reasons to invest in the country. Get all the details on our website. And could Mark Zuckerberg be the wealthiest 20-something ever? Facebook shares surged yesterday, increasing Zuckerberg's wealth to nearly $30 billion. Read the full story at cnbc.com. And remember, you can also follow us on Twitter at CNBC World.
Right, soccer. UEFA's fair play rules are meant to create more financial stability amongst soccer clubs. However, that hasn't stopped teams from spending tens of millions during the transfer window. Juan Mata became Manchester United's record transfer when he joined from Chelsea for £37 million. That freed up a bit of cash for the Blues, and now they've signed Mohamed Salah from Basel. Yohan Cabaye is the latest big transfer for Paris Saint-Germain, who paid $90 million for his services. Mark Roberts, senior manager at the Sports Business Group of Deloitte, joins us now. This, just that on its own, just underlines how financial fair play is a mockery, isn't it, really? The big, I don't know, what is it, 7 or 8, possibly a dozen clubs in Europe, they can do what they like and the rest are struggling, isn't it? I mean, when we look at a club like Real Madrid, I think there's Yianos, 590 million euros in debt. How does that adhere to any financial fair play rules?
I think if you look at what UEFA are trying to achieve with financial fair play is a balance of revenues and costs, you know, throughout the seasons. Clubs are allowed an acceptable deviation. It's not a measure of debt, it's about incomings and outgoings on a seasonal basis. And if you look at that, then clubs are aware of what the regulations are, they're aware of what the possible sanctions are. And if you look at UEFA's latest documents on fair play, financial fair play, then clubs are moving towards that those sort of guidelines that they're working towards. If you look at the latest transfer window, yes, there is an amount of around about 100 million being spent in the Premier League, but the net spending, so the ins and the outs, are probably netting off to pretty much break even. So again, the transfer spending is a lower in this window.
Well, yeah, but I can buy a player for 35 million and then have 10 sales of 3.5 million, you say it's a net, but it doesn't mean to say that those sales of 3.5 million, I didn't pay 7-8 million on average for those players. So maybe that it's netting off, but the fact of the matter is these clubs are still spending enormous amounts on these players, and actually 1 in 2, 1 in 3, whatever it may be, it's not working. Look at QPR for an example. Look at a lot of the City offloads as well. They pay X for a player, they sell them for a significant amount less. City don't ever sell players at that they paid X price for. They don't sell them at a premium, do they?
I think if you look at what we're trying to achieve from UEFA's perspective is revenue growth. There's revenue growth in the Premier League. We're just talking this morning about BT's growth in terms of sports subscribers. They're putting money into the game in terms of the broadcasting side. The commercial side of football is growing. So those clubs that are growing the revenue side then have the opportunity to spend on players, on transfers, on wages, but the revenue side is growing as well. So
it's the media organisations that are getting the clubs out of jail, yeah?
If you look at the growth in football at the moment, it's on the commercial side, the commercial growth in the game through partners, sponsors. That is where the big growth is.
Just to finish off on my questioning, 590 million in debt at Real Madrid, that doesn't matter. They can every year they can buy another 85 million pound player, can they?
I'm not sure of the debt figures for Real Madrid as to what they exactly are, but in terms of what we would say is debt is not a bad thing if it can be serviced, if it can be looked after from the ongoing operations of a football club. It's not necessarily a bad thing. Other companies in other industries take on debt as long as it's manageable.
All right. Yes.
It just appears to me that this is a really true idiosyncratic leveraged play, and if we are to face a higher cost of money globally in the course of the next few years, then the old proverbial issue of finding who is wearing swim trunks and who doesn't might become a very pressing issue for a number of those teams. I mean, this could destroy the game at extreme. It looks like a party right now, but then again, it's almost the pattern that we've seen in other markets too. I mean, it's not that if things go sour and things get more expensive to borrow and buy players, that you can play more games and make up the money. So what do you do? How do you buy time if things turn around the wrong way?
Well, I think we've been hearing that the football bubble is going to burst for the last 20 years. But yet there are broadcasters who are interested in the game. There are people still interested in the game. If you look at match day performance, the demand for the live product is still really strong. As I say, broadcasters are coming in, commercial partners want to be associated with the game, want to be associated with clubs, want to be associated with the tournaments that football puts on. So I take your point, but what I'm saying is that if you look over the past 20 years, then people have been saying that the football bubble is going to burst, and yet there's always interest there. There's always interest from investors, looking to get into clubs. So the fundamentals of the game, the revenue side, the demand for the game is still really strong.
I agree with you, but it's a question at what price, and if you have to generate this at a continuously higher price, that becomes possibly an issue later on. I mean, past performance is obviously not the guidance here. What I would really like to know, just if I can pose that question, is who's going to win the World Cup? I want to ask a better specialist than I am, because there's a lot of money at stake, and it's an idiosyncratic bet anyway. Perfect for a year like this.
Yeah, I think you would look hard to look outside of the continent itself. So maybe one of the teams from the continent of South America looks quite strong.
A country that starts with a B.
Maybe starts with a B. Maybe starts with an A.
I was thinking of Belgium, actually, but sure.
They're quite strong. They're the strongest European team along with Germany at the moment. So
great.
I do just want to belabor the point, because you talk about the money coming into the game, and I get what you're saying about the commercial revenues going up. I mean, BT paid 1.4 billion for those Champions League rights, but whether it's Mansour bin Zayed Al Nahyan or Roman Abramovich or any of the other major investors, none of them have made money out of their investments, have they?
Football isn't seen as a trophy asset, a football club.
No, but you were talking about the finances, getting them on a sound financial footing. I appreciate what you're saying about trophy asset, and I think that therein lies the truth. But none of these guys who've put money into these clubs have made money out of it yet, have they? So you're talking about an input which can't be quantified in real terms with the rest of us, because these are very wealthy individuals worth many, many billions of dollars who are looking for a Rolex watch, looking for a lovely personalised Bentley looking for a soccer team.
Yeah, and as I say, what we're looking for in the, to go back to your point about financial fair play, is all about the year by year incomings and outgoings, looking for a break-even position, and that is what clubs are moving towards. If you look at the trend over the last 2-3 years, and that's what UEFA are looking for in the sort of medium to long term, is that in year out break-even position.
Sure.
I don't really have much to add to this. I mean, I think it is a game effectively that's dominated by large egos. Rich men buy football clubs as they used to build follies in the old days.
I just think the number of noughts on the end has just maybe gone up.
Well, what always intrigues me though is when we have a banker's bonus conversation, people start using the football striker analogy, but nobody seems to complain too much about how much we pay star football players. Anyway, thanks so much for coming in. Real pleasure hearing from you. Mark Roberts, Senior Manager, Sports Business Group at Deloitte. Oxymorons.
Yes.
We want to come back to this and just wrap up with it, because you gave us 6 investment directives, rites of passage for 2014. What are they and why do they matter?
Okay, well, the biggest oxymoron here is that, 2014, we describe it as simply difficult. And starting from that, you have to actually start digging a little bit more in terms of your investment directives. One of the, to use the oxymoron part of it here, is that one of the directives we have is stick with the morons but carry a stick. In essence, and you probably experienced this more than I have, as when guests come in, it appears to be a very heavy consensus for 2014 and what's going to happen with the global economy, what's going to happen in the US, but it's a year of adjustment. So heavy adjustment because we're going to a different regime with respect to the cost of money. Not necessarily tomorrow, but we are in that stage. What do you do in this process? How do you carry a stick while being together with the morons? Is you have to figure out what are your extreme scenarios here, and there are basically 2. One is that the US fails in the process of dealing with a higher cost of money. The other one is that the convalescent, instead of being, just being to walk without a walker, you can actually run. So you have to really focus a lot more, not on your base scenario, but the extremes.
We've got to wrap it up. Yianos, thanks so much for coming to us. Yianos joined us from Eurobank Asset Management. That's Squawk Box, everybody. Thanks for tuning in. We'll be back Monday, but if you celebrate it, have a wonderful Chinese New Year. Gung Hei Fat Choi, everybody, for the year of the horse. We'll see you Monday.
Discover a pioneering Forex investment platform from the best FX broker of 2013. FX Pro. Trade Forex like a pro.
I really want you as Chief Operating Officer of my new company. Do you accept? I do. Welcome aboard.
When you're passionate about your people, you take care of them with the best insurance solutions.
Our job, of course, is to do what is best for the real economy and have markets adjust around us.
I'm optimistic about growth at the end of the year and the beginning of next year. I'm optimistic about the core U.S. economy.
If tapering takes place because there is a view that the U.S. economy is doing much better, I think that's a positive sign for Mexico.
We're in a growth position, emerging from the bailout, first Eurozone country to do so.
We are in a position now that we have only upside.
The recovery is still in its infancy. It's gradually progressing, but it's still weak, uneven, and fragile.
Egypt is an important country in this region. It is not in the interest neither of Egypt nor the rest of the world to have bad relations.